Hey there, everyone, and welcome to the Final Bar. It's Thursday, May 2nd, and I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com. Pretty nice sunny day here in Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. If you're not convinced that charts and technical analysis will be helpful to you, I challenge you to come up with a better toolkit to try to make sense of these markets. We have so many moving parts, with commodities having an incredibly strong first quarter, pulling back so far in Q2. Stocks having an incredible strong Q1, pulling back in April, choppy here in May. We have the Fed meeting. We have tons of earnings coming in and out. All of those things arguably can be best reflected by analyzing charts. And by having a consistent process of looking at the charts, you can hopefully have a good sense of what's happening around you. I find a lot of individual investors, particularly as they're trying to build their toolkit and build their processes, they tend to be sort of confused and have a disconnection to what's happening in the market. They're often surprised that something moves and they missed it, and there's this fear that you're going to miss out on the next thing. Tools like Stockcharts.com that have scans and alerts and chart lists to allow you to systematically review the market conditions and recognize when they change. That is how you apply some superpowers to your process, as it were. Hopefully we give you some ideas of how to upgrade your own processes here with our show, The Final Bar. We have a great guest today coming up a little bit later, Adrian Zduńczyk. He's our favorite crypto expert, going to talk to us a little bit about the Bitcoin halving, what the short-term versus long-term implications are. Also a structural chart talking about Bitcoin, which I'd not seen before, so make sure you check in with our interview here shortly. But before we get to that, let's get to our market recap and look at how the charts played out. Nice up day with growth stocks like the NASDAQ recovering from yesterday's distribution. But before we go there, let's talk about the poll question. Will May 2024 be a positive or negative month for the S&P 500? 2/3 of you agree with our producer, Sky, who said negative, bearish on what's happening here for May. I would probably wholeheartedly agree with that. Now, again, either one of these could happen, right? It could end up being a positive month. But the reality is the best way to answer that question is by looking at the market conditions, and particularly thinking about my conversations with recent guests. We had Adam Turnquist, Gina Martin Adams. A number of our guests in the last couple weeks have talked about this sort of corrective phase, this pullback phase in April. And very few of them that I can come up with said that's the low for this correction. It was more the conditions are still weak, but the long-term picture is sound. And I would 100% agree with that assessment. Short-term weakness, long-term strength is still what the charts on different time frames would tell you. Make sure you focus on key levels, key actionable levels to watch on the S&P, the NASDAQ, and stocks and ETFs that you're following. But I would agree. Negative probably makes more sense to me given the conditions that I'm seeing right now, particularly the breadth conditions. Don't forget to follow us on your social media platforms so you won't miss the next poll. Let's continue with our market recap, looking at the major averages, having a decent day. The last couple days have been marked by a steep sell-off going into the close. This is the first day really in the last couple that we've not had that happen. Markets actually held in there. It was funny. We started rolling over around 3:30. I'm almost like, all right, there it is again. We're going to go right back down. We did see a bit of a bid come in going into the close, so it wasn't the end of the world. The S&P finished back above 50/50, closing around 50.64. That's 0.9% higher than Wednesday's close. The NASDAQ Composite even better, 1.5% up to 15,840, we'll call it. Mid caps, small caps, all having a decent day, with the small cap 600 up 1.5% as well. The VIX, look at this, back below 15, and that's sort of that key level we've been talking about. You know, really over the last week, the VIX has been toying with that 15 level. I feel like these markets right now are very much in a transition. We obviously have had a pullback in April. Now as we begin May, a lot of stocks are pulling back to key support. We talked about AMD testing its 200-day moving average. Stocks like NVIDIA, getting down to their 50-day moving average. The question with a lot of these, Bitcoin, hitting key moving average support, does it hold that moving average? Yes or no? Does it hold the recent swing low? Yes or no? And the VIX is really chopping around as well. Sort of a wait and see mode, I would say, with volatility. But the longer the VIX would stay below 15, if that's how this week plays out into next week, the harder I would be pressed to think a lot more downside is coming, because the markets don't tend to correct on low volatility. They tend to go up on lower volatility. They correct when investors are getting nervous, and that nervousness is reflected in elevated volatility, and the VIX goes up. That's why the VIX is known as the fear gauge. Fear is not the way I would describe a VIX below 15. So keep an eye and see if that is a one-day thing or a multi-day thing going into next week. Look at the chart of the 10-year yield over the last 2 days, opening higher but then trading much lower. So the last 2 days, even with the Fed meeting yesterday, last 2 days almost identical for the long bond yield, which finished today right about where it started, around 4.72%. 10-year yield coming off even more, down to 457, almost the same for the 5-year point. Of course, we still have an inverted yield curve. No real, I would say, change in what the Fed told us in yesterday's press conference. Powell really sort of reinforced a lot of the same things that they've talked about. If anything, sort of taking multiple rate cuts, becoming less and less of a scenario this year. Now I'm hearing people talk about the potential for only one rate cut in 2024. Talk about a big change from 3 to 5 plus rate cuts, which is what we were talking about at the end of last year. It tells you what they mean when they said they were data dependent, and the inflation data has remained stronger than expected. A lot of the economic data has reflected broader strength. That means higher rates for longer, and overall, that's something to think about. Most of us have not been investing in a period of rising inflation and rising rates, as my guest Gina Martin-Adams mentioned earlier this week. The dollar weaker today, down about 0.8%. So weaker dollar certainly reflecting the strength in stocks. That's been an inverse relationship pretty consistently here for stocks versus currencies. Looking at the commodity space, the DBC, which is a broad commodity ETF, was up about 1/3%. Silver about the same. Gold actually was down slightly. Copper prices down as well. Crude oil, not too much change from yesterday's close. Natural gas prices up in a pretty decent way. Energy stocks not doing particularly well. When we get to the individual stock component of our market recap, we'll hopefully get to names like DVN, Apache, ConocoPhillips. These are all earnings names. As a quick preview, the charts do not look particularly strong at the moment. We'll see how they're looking here after today's close. Bitcoin starting to chip away back to the upside. Again, we have a great guest today, Adrian Zduńczyk, really focuses primarily on this space. So I'll let him tell us a little bit more about the short-term dynamics for Bitcoin. But I'm eyeing that big round number, 60,000. Excuse me, Bitcoin breaking below 60,000 over the last week. I would argue one of the most concerning pattern developments that I've seen in the crypto space in a while, because that tells you that range that we've been in Bitcoin for a while now, April, May, now starting to break to the downside. I think that opens the door to further downside for Bitcoin before we finally find its footing. So for now, weakness versus strength. Look at technology, back to the top of the leaderboard, just barely edging out real estate. Both of those basically tied for first, up about 1.4% from yesterday's close. Consumer discretionary, number 3, up 1.3%. We haven't seen the XLY up at the top of the leaderboard for quite some time, given the weakness that we've observed in Tesla in 2024, but for one day, back up to the top. Only 2 of the 11 S&P sectors were down today. Materials down 0.5%. Healthcare essentially flat for the day. And then financials up about 0.25%. Let's go to the market model. Looks like things are changing a little bit with the small cap and NASDAQ 100. Again, all of these bouncing higher. And I'm guessing this is the medium-term model starting to change again. The good news is we start to do this. We start to update these models as we're recording the show. But for now, short-term model remaining bearish for the S&P 500. That might be something to watch going into Friday's close. All right, the Magnificent Seven and friends, this group of leading growth stocks. The fact that Tesla wasn't down, I think, is probably the most encouraging thing that happened. That's why the XLY is up so much. You have Amazon up 3%, Tesla not down. That's going to mean the XLY has a pretty decent day. Now, NVIDIA was the best performer of the group, up about 3 1/3%, followed by Amazon. Netflix up 2.4% as well. The laggards today in this group were Tesla flat for the day, Meta up 0.6%, Microsoft up 0.7%. So all of those leading growth names doing just fine today. Looking at the chart of the S&P 500, we talked yesterday about this potential bear flag pattern. I actually put these lines on, I believe, as we were doing the show, if I remember right. But yesterday I remember putting these on here. I have them saved. Now today we did not get that downside follow through to confirm the bear flag pattern. I'm not too worried about it just yet, because what a bear flag pattern is it takes weeks to actually evolve this pattern. What that is when you have a big down move, then you have this counter trend move to the upside of higher highs and higher lows on a shorter term time frame than the broader decline. And the way that you confirm the bear flag is you break down out of that pattern to the downside. And when that would occur, if that would occur, you assume that the trend leading into the pattern is reflected with a similar time and duration and price value coming out of that pattern. And if that would be confirmed going into the end of this week into next week, that would suggest further downsides around 48.20 for the S&P 500. But we did not get that validation today. So I'm looking for a breakdown through that trend line to confirm the bear flag pattern. Again, the momentum is more negative with the RSI below 50 since the second week in April. So I'm still seeing this as a downward pullback phase, and I've not seen enough improvement to change that point of view. S&P back above the 50-day, back above that swing high from late April. That might get me to change my mind, but until then, I'll hold off. Did want to highlight the McClellan oscillator. We talked about the VIX sort of chopping around that 15 level. Same thing, you have the McClellan oscillator chopping around the 0 level. It's sort of annoyingly going back and forth, one day below, the next day above. And all that means to me is that the breadth data is basically neutral. The McClellan oscillator pops up and down based on the moving averages, the smoothed out version of the daily advanced decline data. And what happens when you have an up day and a down day and an up day and a down day, a lot of volatility just day to day, you have a breadth indicator like this chopping around the 0 line. So no clear signal at the moment for the McClellan oscillator. It doesn't seem like a clean break to the upside or the downside, but we'll continue to monitor this, of course. I do want to show briefly some of the sentiment indicators that we like to track. Thursday is when a lot of the weekly sentiment indicators are updated, usually Wednesday into Thursday. So I did want to briefly just take a note. This is the AAII survey, which is a weekly survey of individual investors. You can see that the bullish reading went up from around, we'll call it, 28% up to 38%. Might have been a little more than that, actually, over the last week. The bears remaining fairly steady around 33%. So bulls slightly outnumbering bears. It actually, we saw bears outnumbering bulls last week for the first time since the October low. Started to be a little more negative. I'd keep an eye on that and see if you do continue to get an improvement in sentiment. Certainly would suggest a little more optimism than we've seen recently for equity investors. No real change to the name exposure index this week. If you're not familiar with this one, I talked to Ryan Redfern, who's the president of NAME, which is the organization that conducts this survey of their members every week. So go back to my interview, I think that was last week, where we talked about this indicator, among other things. The NAME exposure index remaining pretty low, around 62%. That's underweight the average, which I would usually see is around 70 to 80%. So we're kind of underweight stocks based on that survey of money managers, not really buying into this short-term upswing just yet, more risk off than risk on. Briefly, let's look at commodities, and I want to go through some individual stocks on here. Crude oil prices coming off. We'll look at the crude oil contract. It wasn't a big down day today, but yesterday, crude oil future went down from around 82 to 79, and that's where we ended the day yesterday. It was up slightly today, but back below the 200-day moving average, back below $80 a share, and I think that's important. It was sort of generally said, crude oil above $80, pretty bullish for energy stocks, and that's what I think helped fuel that rally that you saw in I almost said Bitcoin, energy stocks from mid-April to mid-March to mid-April, that is. But then you start to see crude oil prices come back down. When we look at the charts of DVN and some other energy stocks here, you'll see that they're pulling back. And I think part of that is sort of a risk-off move for stocks, but it's accentuated in the energy sector by the weakness in crude oil. Those stocks do well when crude oil prices are are higher than they are, and crude back below 80 is not a great look. So I think those stocks present a potential good opportunity if and when we can see crude oil pop back above the $80 level. With that in mind, let's go to some individual names. A lot of earnings this week. Again, we don't have a chance to go through all of the stocks, but I just want to highlight some of the key names, some of the key movers here relative to their earnings releases. Couple names after the close yesterday. DVN was one of those, and you can see sort of a brief deterioration over the last couple weeks. After making a new swing high around $55 a share in early April, we made a higher low around 51, but then look at this, lower high around 53. Now we've undercut that swing low. So certainly in a downtrend phase for now. DVN is rapidly approaching its 50-day moving average, the RSI approaching the 40 level. If this is a stock that's going to work, that's kind of the place where you might expect it to happen. And if you don't see buyers come in, that's usually a warning sign. Again, crude below $80 a barrel doesn't make me feel particularly great, about the likelihood of that stabilizing. Crude getting back above 80 makes this a pretty potentially interesting pullback opportunity. Now, other stocks within that sector, energy, that reported before the open today. We had Apache, which is an E&P stock, exploration and production, down 4% today, actually retesting the previous swing low here. I'm going to look at the unadjusted data, and you can see we've undercut that February low just slightly. That was around 29.50, we'll call it. We ended the day just below there and traded down to around $29 a share. Apache now oversold for the first time since, I will call it, early February, but previous oversold conditions usually mean at least a bit of a bounce. I'm wondering if there's a bounce off of price support as we enter that oversold region. Look for the RSI to come out of the oversold region. That's usually your opportunity to trade a bounce on the way back up. ConocoPhillips also reporting earnings down 1.7%. This is one of the big integrateds. Exxon, Chevron, Conoco, these are the big integrated names. A lot of market cap represented with those three stocks, which dominate the energy sector. You can see today closing below the 50-day moving average for the first time since early March. So the technical configuration, a lot of these energy names, not particularly strong. Again, think of energy as a play on oil prices, generally speaking. And again, oil above $80 a share, I think, makes these interesting charts. Until then, I think you're tracking them, but waiting. I think you need to be patient there. Another stock that reported after the close yesterday, MGM, which is one of the stocks in the gambling group, obviously the casino space in Las Vegas. You can see that we opened higher but traded lower. So we actually traded all the way up above the 200-day, above the 50-day. But look at this. Even though we closed about 3% above yesterday's close, we closed back at the lows of the day. That concerns me a little bit, right? Because we were oversold yesterday. We have a gap higher on earnings, but then we fail to get above any of those meaningful resistance levels, and we actually close back to the lows of the day. So certainly today's gap higher met with a lot of selling, pushing the price back toward the lows. Penn National also reported before the open today. This one gapped down big time and just kept going. It did come back to close around 15. That's still down around 9%, that is, from yesterday's close. While MGM, actually, you could make an argument based on where it's at. Penn, I think you have to. I think this is the type of chart that I certainly like to avoid because it's below two downward sloping moving averages. And when stocks trade up to the 50-day, a declining 50-day, and fail to get above there after they failed a number of times to get above the 200-day, this is a chart that you wait to see when there's signs of accumulation. Today telling you today is not the day. Peloton reported before the open as well. Interesting technical action. We opened higher. We closed basically not too far off of yesterday's close, down about 3%. And at the open, it felt like this is a nice, really encouraging reaction to the earnings release. But similar to what we saw with Penn, that gap higher met with a lot of selling through the course of the day. We remain below two downward sloping moving averages. So when people ask me about this type of chart, my general answer is the Paul Tudor Jones quote, nothing good happens below the 200-day. I get excited when a chart like this starts to change its character by showing signs of accumulation. You're not seeing that here yet. Moderna, one more reporting before the open today. You can see here, and it's sort of an interesting pattern. I mean, you could probably describe this as some sort of weird inverted head and shoulders type of pattern. It's not a perfect one. You can see it's sort of a complex head and shoulders-ish thing that's happening here. That's my official technical analyst way of describing this chart. But I do want to highlight that if you do think of this as a head and shoulders bottoming pattern, what you do is you say there's a low surrounded by higher lows. And there's the higher low in August, higher low in February. You have a little bit of noise here on the right, and we never really broke above the neckline. And that's why Moderna was sort of a wait-and-see chart. But today, you're finally closing above that neckline. And I think, arguably, that completes this bottoming pattern and suggests much further upside. The way that that pattern's measured actually suggests a return to the December 22 high, up around $200 a share, which would be, another 80% gain from current levels. That's not too bad if that would play out. I'd also point out a Fibonacci retracement using the high here and the low there. Look at how we sort of come up with similar levels, right? So this 38.2% level here around 122 today actually pushes us above that 38.2% level. Not too bad for Moderna. Nice follow through today. We'll see if it continues. We have a couple names reporting after the close today. Coinbase is a key one, obviously a play on Bitcoin. DraftKings, Square, because PayPal has had an interesting move recently. I think all of those are of interest, but Apple probably the most important. As a reminder, Apple is bouncing off of key support. 165 was the low in October. 165 was the low a couple weeks ago. We're now trading up to a descending 50-day moving average, and we've had some negative candle patterns like shooting star candles as we've attempted to get above. Earnings are most likely going to push this above the 50-day and ideally above the 200-day. That would be a nice bullish development. Below 165, though, and Apple looks like a pretty questionable chart with the RSI almost dead even right around 50. That's our market recap for a Thursday afternoon here in the heat of earnings season coming off of the Fed meeting this week. We have a great guest today to talk to us a little bit about cryptocurrencies, Adrian Zduńczyk of the Bird Nest. Before we bring Adrian on, just one reminder, we'd love to hear from you. Appreciate so much all of your thoughtful feedback on our show over the years, but especially we appreciate your questions. We're going to do an all mailbag show on Friday of this week, and we'd love to answer one of your questions in our next mailbag show. Email is always best, thefinalbar@stockcharts.com. We'll get your question right in front of me. Do me a favor and include the link, the permalink as we call it, which is the little link icon you see below your charts on Stockcharts. Include that so I can see the live version of your chart. And on YouTube, of course, just drop a comment below the video that you're watching. We'll hope to answer your question in our next mailbag show. I want to welcome on today's guest, Adrian Zduńczyk. Adrian's the founder of the Bird Nest, one of our favorite crypto experts to bring on here. He's a CMT charter holder back home in Poland. Adrian, thanks for joining us today. How are things your way, okay?
Oh man, thank you so much. It's great to be back. Yeah, I got out somehow in a miracle's way, out of the floods in Dubai, which was crazy. Expect the unexpected, right? So now I'm back in Poland. Halving is already behind us, which is quite interesting to see what's happening on the crypto side. And I'm all here for it, my man.
No, it was great to see you. You and I saw each other last in Dubai, and when the weather was happening, I was glad to hear that you were weathering that whole environment okay. Let's get to the charts of Bitcoin and what you're seeing. You mentioned the halving that happened in April. Help us sort of get a sense of where things are at. There's been a lot of movement in the crypto space here recently. We're starting you with your weekly chart of Bitcoin. Talk us through where you're at in terms of the trends here.
Correct. Yeah, so that's a quite an interesting kind of like a take on the halving side, because halving on its own is an even trading day, just like it is for the FOMC announcement, like it is for the CPI release, for the unemployment data, and so on. Each and every single even trading day is characterized basically by increased volatility, increased risk in the financial terms, right? And it doesn't necessarily pertain any particular direction. So it just chops around on a more kind of like a roller coaster basis. The volatility is higher, risk is higher at the same time. However, it's not constructive. It's just an elevated level of noise on the short term. And then after it kind of like comes down and cools off, the whatever asset it is that we're talking about, it actually continues the previous prevailing trend and the dominant trend. And here the trends can be associated with the rising 200-week moving average and the 50-week moving average. Both are rising consecutively, consistently. This tells me that on the long-term basis, the trends are very bullish, right? There is not a single piece of doubt that there is very one direction. And this also tells me that the dips, the corrections, the corrective types that are in the opposing direction to the main prevailing trend can be considered most of the time on a mean reversion basis by the dip opportunities, right? We're not in the bear market, kind of like a regime where the trends are falling and those corrections are an opportunity to sell. We're actually talking about those gifts from the market at times, that if Bitcoin gives us an opportunity to buy at a 25% discount of the peak from $74,000 that is just pulled off towards $56,000, $55,000 on some exchanges, I would argue that it's quite a creative opportunity for a lot of traders. In the hindsight, just like it always shows, there's a hindsight bias. Everything seems obvious in the hindsight. However, most of the time, those corrections in a very strong, very well-defined rising environment of the bull market are typically giving us good results. So on the bottom side, in the bottom clip, there is a correlation coefficient for Bitcoin against S&P 500 on a 7-week basis. Correlation coefficient is basically covariance against the product of standard deviations of telling us a little bit like how Bitcoin and S&P co-vary, how they change together, how they move together versus the product of their overall standard deviations of the entire kind of like a pool. This tells us that at 0.75 is a strong, firm correlation, and it stays there right above the zero level for quite most of the time, right? It stands there, again, wild guess, I didn't calculate it, so take it with a grain of salt. I would say that it stays there for about 85, 87% of the time historically. And there are only very single dips that happen to kind of like stay for a little bit longer below that zero level line, right? And whenever that happens, at least ever since this bull market started, this marks quite the end of a corrective movement, right? This kind of like marks and aligns with the bottom of the market corrections, which is interesting. It doesn't necessarily guarantee, of course, the future results. However, I would say it's something to pay attention to. And the correlation is strong. This also kind of like brings a lot of similarities on the seasonal side. And here's a big shout out to my friend Jeff Hirsch, who's the very godfather along his late father Yale Hirsch, the creators that behind all the entire framework on the seasonal studies. And being in this election year from 12.8% annualized return expected when the current president is running for the re-election, that happens to be this case for the election years. This particular setup historically decreases the amount of uncertainty among traders. That proposes more risk exposure, more willingness for a risk-seeking basically approach. And that bolsters basically by about 30-40% more for the S&P 500 returns over the typical 8 to 9% annualized return. So 12.8% versus 8 or 9, that's quite a change, quite a difference. And in this context, with this strong correlation and resemblance on the Bitcoin side, which stays most of the time similar to S&P, there is this additional seasonal tailwind, I would say, that pushes us better and higher. So there's a comment that I have also on the daily chart on the more technical side and how it correlates with the halving. So having just got the fourth halving, which happened on the 20th of April, I would say it's quite an interesting case, right? Because like I said, it is similar most of the time to those FOMC unemployment data, CPI release situations that, again, just bring a little bit more noise and uncertainty, which is shown clearly in the local turbulence, from the 74,000 approximately down to where it is right now, about 58, 56,000. This is quite close to this magical level of 50,000 that aligns quite well. It will soon align quite well by the base of 200-day moving average that represents the bull market tendency. That is very well defined. It's very firm. It's very strong. It's undeniable. Again, we're talking about facts. We're not talking about predictions. We're talking about facts. The 200-day moving average is rising. It's a fact, and that represents the bull market Bitcoin trend, right? And those trends tend to often work for many reasons as those magical level of supports, right? Because some of us we'll try to search for some line in the sand basically proposed by the moving average, and we will anchor to it and be attracted. Our eyes will go there, and because such thing happens, we will place our bids there and just wait patiently at times. And those bids stack up, causing this clustering of orders that causes the support to exist on a self-fulfilling basis, which is interesting. However, then mean reversion level at around $50,000 tells us that the market tells us, hey, this is the market reset. At this level, we're back to normal. We're back to regular pricing. This is a fair price, otherwise, quote unquote, right? So on those terms, I would argue that even if we see the $50,000 retracement towards this area, again, historically buying into dips into a very well-defined, strong, firm bull markets is a winning strategy. Until at least 2026, that is a good candidate for the bear market. Like 2022 was, like 2018 was, 2014, 20, and 10. And that aligns also with the halving cycle. So the halving cycle for Bitcoin approximately lasts also around 4 years. And it seems to align with the presidential stock market cycle very well, right? This is the fourth halving. Every halving happens not based on a time cycle basis, it happens on a block size, or actually on the block count, right? Every 210,000 blocks. And it happens just that it collides and aligns so nicely with the Fourier presidential cycle on the stock side. And there's this additional, like I said, alignment, this congestion and alignment confirmation of both cycles, which are technically independent. However, at the same time, they align. So this may come as an additional incentive. So the halving historically brought incredible rallies. We're talking about the first halving that brought 9,000% rally from the first halving to the subsequent peak in 2013 at 1250. We're talking about the second halving that brought 3,000%, 9,000% of the first one, 90x, 3,000%, 30x on the second halving from the halving price to the subsequent peak in 2017 at around $20,000, which is where the CME futures came in and the market tanked 85%, which is interesting timing. And then the third halving came in May of 2020, and ever since Bitcoin was there approximately 9,000%, it gave us 700% return approximately towards the peak in 2021. So the facts are those are powerful rallies. We're talking 9,000%, 3,000%, 700%. There's this diminishing tendency, it seems. It may be due to the lack of enough sample. The story side of Bitcoin is a little bit short compared to that. For instance, with almost here 100-year S&P history. Not even mentioned Dow Jones. So we are a little bit limited on the data. Still, there is some positive tendency that most of the time traders spend in a profitable fashion, by playing those, buying into whatever price of the at the halving was, and staying there for a long time. And correct. And the last chart is from Macro Micro, which is the service that I use to tracking average mining cost, the production costs of Bitcoin. And what happens after halving is basically the halving rewards for miners go down by half, which means that they have to work twice as hard or more, including the competition, harder basically to produce the same amount of Bitcoin. It becomes increasingly more expensive to mine and produce Bitcoins. And there is this very, very interesting spike on the blue curve, which represents its actual production costs, which took us anywhere from $40,000, $50,000 just a couple of weeks ago to above 110,000. We're talking $113,000 that it costs to produce one Bitcoin. And as a matter of fact, this massive burst, this massive tendency, it may be showing and giving us a little bit glimpse into the future, right? Even though the future is unknown, we have no idea. I cannot know what's even going to happen in the future. I'm ignorant as much as I can be. However, it tells me that historically, this kind of like paves the way, showing, hey, this is the break-even level for the miners. This is where the mining business is profitable. This is just where we break even. And everybody wants to make money to a large extent, right? If they're running a business, what's the otherwise cause of running a business? Putting aside, doing goodness, obviously, and adding value to the other people. However, from the mining side, from the financial side, it's just twice as much expensive as it was a couple of weeks ago. Typically, it shows a little bit early glimpse into the future for what the prices might be, just to break even. And then we're talking about the profitability levels. So there's maybe a little bit of a glimpse of what may be to come on the price side.
Adrian, this has been a 10-minute masterclass on how to think of Bitcoin in May of 2024. This is awesome. We talked about the trends, the long-term trends overall remaining quite strong. The correlation, which I had not really thought about between stocks and Bitcoin, pretty powerful. And then some of the structural changes with the halving, with the mining costs. Really thoughtful charts, and appreciate so much your comments, Adrian. Be well, and thanks for joining us from Poland. We'll talk to you again soon, all right?
Thank you so much, Dave. You're awesome. Thank you.
That's Adrian Zduńczyk. Adrian's the founder of the Burb Nest. I thought that was fantastic. I mean, what a beautiful walkthrough. I didn't want to get in the way of that, eloquent way of describing the long-term trends remain strong. The short-term pullback has gotten us to points where normally it's kind of the time to accumulate based on the big round number support around 50K, which we've talked about, the 200-day moving average, all kind of aligning in that particular area. What I love about someone like Adrian, he's combining the technical inputs with some of the other structural components. What does it mean when Bitcoin goes through a halving cycle? What has happened historically ends up being pretty positive the next 6 to 12 months out. And it looks like the average mining costs sort of supporting that perhaps as well. Great take there by Adrian Zduńczyk, founder of the Burb Nest. Folks, that's it for the show. Thank you so much for joining us every weekday after the close. And we'll be back with you again tomorrow. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.